What's up, guys? In this video I want to show you the first step of how to be a successful trader. This step is the history of the forex market. I will tell you the story of the forex because you can't be successful if you don't know how the forex market came into existence. Don't forget to subscribe to the channel so you don't miss out the next videos where we will reveal the rest of the steps on how to become a successful in the forex market. Let's get started. Okay, these are our 10 steps. Let's begin with step 1. The currency market as we know it today is relatively recent. Starts with the Nixon shock. The Nixon shock was a series of economic measures undertaken by United States President Richard Nixon in 1971 in response to increasing inflation, the most significant of which were wage and price freezes, surcharges on imports, and the unilateral cancellation of the direct international convertibility of the United States dollar to gold. Before 1971, the US dollar was fixed to gold, and from there all other major currencies were fixed to the US dollar: British pound, French franc, and the German mark. In March 1973, the fixed exchange rate system became a floating exchange rate system. The currency exchange rates no longer were government's principal means of administering monetary policy. Since then, the foreign exchange market has existed as we know it today. The value of a given currency is determined primarily by its supply and demand. Generally, as price increases, people are willing to supply more and demand less, and vice versa when the price falls. The law of demand says that at higher prices, buyers will demand less of an economic good. The law of supply says that at higher prices, sellers will supply more of an economic good. These two laws interact to determine the actual market prices and volume of goods that are traded on a market. Several independent factors can affect the shape of market supply and demand, influencing both the prices and quantities that we observe in the market. The price in the forex market follow the same rules. Nowadays, the foreign exchange, or more called forex market, is the one with the largest daily volume, much more than the stock market, crypto, and the others. We can make a comparison. Around 1980, a few years after the currencies are free floating, daily volume was about 68 billion US dollars. Whereas today it is over 6.6 trillion dollars and develops and expands day by day. Let's take example with the territory of Bulgaria. This is the territory growth by 97 times. At the very beginning of the forex market, it was intended primarily for large investors and hedge funds, mutual funds, investment and retail banks. Over the years and the mass penetration of the internet among ordinary customers like us, the foreign exchange market becomes readily available to small speculators and traders. Retail traders, often referred to as individual traders, buy or sell securities for personal accounts. Retail traders typically invest in stocks, bonds, and futures, and they have minimal to no access to initial public offerings. Most trades are made in round lots, but retail traders can trade any amount of shares at a time. Retail traders are more likely to invest in small cap stocks because they can have lower price points, allowing them to buy many different securities in an adequate number of shares to achieve a diversified portfolio. Brokers today offer a credit arm, which is called leverage, with the help of which small traders like us can open positions in large sizes and hence the opportunity to make money. Leverage is the use of borrowed funds to increase one's trading position beyond what would be available from their cash balance alone. Brokerage accounts allow the use of leverage through margin trading, where the broker provides the borrowed funds. It is important to mention that the foreign exchange market is open 24 hours a day from Monday to Friday, enabling traders from around the world to take advantage of the unlimited opportunities on the forex market. We trade 8 major currencies of the most developed countries: US dollar, Canadian dollar, Australian dollar, New Zealand dollar, euro, Swiss franc, English pound, Japanese yen, and the different combinations between them. We prefer currency pairs that make large movements. In order to make profits, we need strong volatility that we can catch. Of course, there are many other currencies that are called exotic, like the Brazilian real, the Mexican peso, the Russian ruble, and the Singapore dollar, which are also becoming more common traded. But if you want to trade them, you have to know that there are higher fees. Information related to the economy is difficult to get and not so often translated into English. Of course, you can decide for yourself whether you like it or not. So guys, this was in short the history and fundamentals of the Forex market. We hope you liked the video. If you do, hit the like button and don't forget to subscribe to the channel. We are going to upload the second step of how to be a successful trader next week. In this time, you can watch our weekly analysis to see our opinion on what will happen on some of the most traded currency pairs for the next week. This was everything for this episode. See you next week.